Navigating the shadows. Unveiling the risks associated with investing in leveraged and inverse ETFs. Introduction. In the realm of exchange-traded funds, ETFs, the allure of amplified returns or inverse exposure can be enticing for investors seeking to capitalize on market trends. Leveraged and inverse ETFs, designed to magnify returns or profit from market declines, present a unique set of opportunities and challenges. Understanding the risks associated with these financial instruments is paramount for investors venturing into the complex terrain of leveraged and inverse ETFs. Leveraged ETFs, the double-edged sword. Leveraged ETFs, designed to provide returns that correspond to a multiple of the daily performance of an underlying index, introduce a double-edged sword to investors. While these funds can deliver enhanced returns, they are not without their pitfalls. One of the primary risks lies in the compounding effect of daily returns, which can lead to a significant deviation from the expected performance over extended periods. Consider a hypothetical scenario where the underlying index experiences volatility. In such cases, the compounding of daily returns can result in a substantial tracking error, causing the actual returns of the leveraged ETF to deviate significantly from the intended multiple of the index's performance. This tracking error, exacerbated over time, can erode the expected returns and expose investors to unforeseen losses. Volatility amplification and market timing. The inherent volatility amplification in leveraged ETFs demands careful consideration of market timing. Investors may find that prolonged exposure to these funds during periods of high market volatility can lead to amplified losses. The compounding effect, combined with market fluctuations, can result in a scenario where the intended multiple of returns becomes a magnified reality, whether positive or negative. Furthermore, leveraged ETFs are optimized for daily performance and may not necessarily align with the expected multiple over periods longer than a day. This characteristic makes these funds ill-suited for buy-and-hold strategies, as the compounding of daily returns can erode returns over time, especially in the face of prolonged market turbulence. Interest rate risks. Interest rate movements can introduce an additional layer of risk for investors in leveraged ETFs. These funds often use financial derivatives such as futures and swaps to achieve their desired leverage. In a changing interest rate environment, the costs associated with maintaining these derivatives can fluctuate, impacting the fund's returns and potentially leading to unexpected outcomes for investors. Inverse ETFs, profiting from declines with caution. Inverse ETFs, designed to deliver returns that move in the opposite direction of an underlying index, present a unique set of risks for investors seeking to profit from market downturns. While these funds can act as effective hedges or speculative tools, understanding the nuances of their operation is crucial to navigating the associated risks. Complications arising from daily resets. Inverse ETFs, like their leveraged counterparts, face challenges related to daily resets. The daily rebalancing required to achieve the inverse exposure can result in a deviation from the expected returns over time. This compounding effect, coupled with market volatility, can lead to tracking errors that may erode the efficacy of these funds as long-term hedges. Market timing and trend reversals. Successfully navigating the inverse ETF landscape requires a keen understanding of market timing and trend reversals. Investors must recognize that these funds are optimized for daily performance, making them better suited for tactical, short-term strategies rather than extended holding periods. As market trends shift, the effectiveness of inverse ETFs as hedges can diminish, potentially exposing investors to unexpected losses. Liquidity and trading risks. The liquidity of inverse ETFs can pose challenges for investors, particularly during periods of market stress. Thin trading volumes and wide bid-ask spreads can result in suboptimal execution prices, impacting the overall returns for investors. Moreover, the risk of market gaps, sudden and significant price jumps between trading sessions, can expose investors to unanticipated losses, especially if market conditions change rapidly. Risk management strategies. Investors venturing into the realm of leveraged and inverse ETFs must adopt robust risk management strategies. Diversification, careful consideration of investment horizons, and a thorough understanding of the compounding effects and daily resets are crucial components of a well-informed approach. Additionally, utilizing these instruments as tactical tools within a broader portfolio rather than standalone investments can help mitigate some of the inherent risks. Conclusion. Leveraged and inverse ETFs offer a unique avenue for investors to amplify returns or profit from market declines. However, the allure of these instruments comes with a caveat: the intricate web of risks that accompany their usage. From the compounding effects of daily returns to the challenges posed by interest rate movements and market timing, investors must approach leveraged and inverse ETFs with a nuanced understanding of their dynamics. By incorporating these instruments judiciously and complementing them with robust risk management strategies, investors can navigate the shadows of leveraged and inverse ETFs, harnessing their potential while safeguarding against the pitfalls that lurk beneath the surface.